A Temu listing can make an ordinary object look cheaper than the trip required to deliver it. That apparent paradox invites a simple answer. Somebody must be losing money on the package. The public record supports a more useful answer. A displayed price is one number inside a marketplace. Fulfillment, marketing, payment, logistics, and import system. It is not a freight invoice. The customer sees a small price, a promotion, and perhaps a delivery promise. Behind the screen are merchants, the platform, fulfillment partners, carriers, payment systems, customer acquisition, returns, and customs treatment. Some of those costs may be paid by different parties at different moments. The listing alone does not reveal their contracts. That matters because price and cost are different questions. A low item price cannot by itself tell us what the merchant paid to make it, what a carrier was paid to move it, whether a platform funded a promotion, or whether the final order made a profit. A package can sit inside an economic system without exposing its full ledger to the buyer. The cost stack is broader than the object. There can be sourcing, inventory, fulfillment, international movement, final delivery payments, customer support, refunds, returns, advertising, and platform operations. Not every layer is identical for every order. But the number on a product tile is still only one visible layer. So the opening rule for this episode is simple. Do not look at a low price and call it proof that shipping costs more. Do not look at a shipping promotion and call it proof of a loss. Those conclusions need evidence for an individual order: revenue, merchant terms, freight, coupons, returns, duties, and costs. The primary sources reviewed here do not disclose that equation. What they do disclose is a marketplace structure. PDD Holdings operates Temu within a portfolio of commerce businesses. Its public description is not a view inside a single parcel. It is a view of a platform connecting merchants and buyers while working with logistics vendors and fulfillment partners. That is the system beneath the listing. PDD's filing describes Temu as a platform that connects merchants and buyers. It also says the company works with logistics vendors and fulfillment partners. The language matters. A platform can coordinate an offer and a delivery experience without owning the factory, warehouse, carrier, or every commercial obligation behind the transaction. PDD reports revenue in two broad consolidated categories: online marketing services and others, and transaction services. Those categories help explain how a marketplace can monetize activity around merchants and transactions. They do not reveal Temu's take rate on a product, a seller's margin, or the cost of a specific customer order. The company also names some cost layers. Its fiscal year 2025 results say higher fulfillment fees, bandwidth and server costs, and payment processing fees contributed to increased consolidated cost of revenues. That is real evidence that the commerce system carries operating costs beyond a product's sticker price. It is not a bill for a single shipment. Demand is another cost layer. PDD said its consolidated sales and marketing expense increased primarily because of promotion and advertising activities. A marketplace can spend to acquire users and encourage purchases while merchants, carriers, and payment providers carry other expenses. The filing does not assign that marketing spend to Temu, a buyer, or an item. This is the honest limit of a consolidated filing. It can reveal that fulfillment, payment processing, promotion, advertising, infrastructure, and platform services exist inside the entire company system. It cannot prove that a particular Temu product is subsidized, that a particular shipment is unprofitable, or that a particular low price is below the cost of delivery. The logistics layer has a similar boundary. Temu's seller site says the company does not directly provide logistics services, while offering integrated logistics solutions and seller fulfillment choices. That statement describes the platform's seller tools. It does not tell us which party paid a carrier, what rate it received, or whether the cost was bundled elsewhere. One package can involve a merchant, a marketplace, a fulfillment provider, a carrier, a payment processor, and a customs entry process. These roles can be connected without being identical. The merchant's product economics can differ from the platform's service economics. The platform's promotion can differ from the carrier's contract. A public price screen collapses that complexity into one number. That is why a list of partners is not a price list. Integrated logistics may reduce friction or combine services, but the public seller description does not allocate freight costs to a specific order. It also cannot establish a universal fulfillment model across countries, product categories, sellers, or dates. The model is visible, The math for a parcel is not. Import rules add another layer, and this is where old explanations can become misleading. Many discussions of cross-border electronic commerce point to Section 321. Historically, qualifying low-value imports valued at $800 or less could receive expedited treatment without duties and taxes in the United States. That historical framework was important. It is not the current rule. The historical channel was large. Customs and Border Protection reported more than 785 million Section 321 transactions in fiscal year 2023. That count describes aggregate customs activity. It does not measure Temu volume, and it does not say that every transaction had identical treatment, cost, or economics. History remains useful only when it is labeled. The old Section 321 framework can explain why low-value parcels crossing borders became a major commercial channel. It cannot be used as a current answer to what duties, taxes, or fees apply today. The current policy baseline changed after that history. Customs and Border Protection says de minimis treatment without duties for imports of low value from all countries ended on August 29, 2025, subject to stated exceptions and applicable duties, taxes, and fees. A February 2026 executive order continued the suspension for covered shipments. That is the current federal baseline at this research cutoff. But the baseline is not a universal price formula. Origin, merchandise, entry channel, carrier, applicable duties, taxes, fees, and stated exceptions matter. A documentary can describe the policy shift without calculating customs charges for a particular order. This is context for the marketplace cost environment, not customs or tax advice. The difference is important. Before the change, a qualifying shipment of low value could fit within the historical de minimis framework. After the suspension, the treatment changed for covered shipments. Neither sentence proves an item's final cost, and neither one proves that a marketplace absorbs every resulting expense. Rules shape the system, contracts allocate the bill. That is why trade policy should not be flattened into a flat shipping fee. A customer might see one price, one promotion, or a shipping message. The underlying order can still depend on classification, origin, entry process, and the choices of merchants, platforms, logistics providers, and carriers. The page does not show all of those decisions. There is also a cost of risk beyond the parcel. In May 2026, the European Commission fined Temu €200 million under the Digital Services Act for failures in its assessment of systemic risks from illegal products. That is a discrete enforcement decision, not a statement about delivery cost or a verdict about every seller. The decision belongs in the larger business picture because compliance failures and enforcement can create real costs. But it must stay in its lane. A European decision about platform risk assessment does not determine United States customs treatment. It does not establish the quality of a particular product, and it does not reveal the margin on a Temu order. The resulting information gap is not a failure of curiosity. It is the central fact. Public documents describe a platform, merchants, logistics and fulfillment partners, transaction services, marketing services, payment processing, promotion, and current import rules. They do not disclose a full invoice for the object in one buyer's cart. The missing numbers are specific. We do not have the manufacturing cost. We do not have actual freight paid for a shipment. We do not have a coupon or subsidy allocation. We do not have a return and support cost. We do not have the duty calculation for that order, and we do not have the profit or loss after every party's contract is applied. Those gaps rule out the viral answers. The evidence reviewed does not support saying every Temu order is subsidized. It does not support saying every low-price item loses money. It does not support saying all duties were avoided. And it does not support a single universal Temu margin. A confident number without the ledger is still a guess. The defensible answer is more interesting than the slogan. Very low prices can emerge from a marketplace system that connects merchants and buyers, sells platform services, uses logistics and fulfillment partners, spends on demand, processes payments, and operates under changing trade rules. Each layer can influence the final offer. None is solved by looking at one listing. So the hidden margin is not a magical shipping trick. The low price is real, but its explanation requires more than the price of one package. It requires separating a merchant's product economics from a platform's consolidated accounts, historical import treatment from current rules, and a striking promotion from an actual ledger for an order. Until that ledger is public, the right conclusion is not certainty. It is disciplined curiosity.